Hello and welcome to On Point, a podcast series focusing on the big topics for corporates and institutions. I'm Peter Shearish, Head of UK Corporate Debt and Financing Solutions. In today's episode of On Point, we're going to discuss what to expect for post-Brexit Britain in both the short and long term. To talk us through this, I'm joined today by Ross Walker, Chief UK Economist, and by Rupert Taylor, our Head of Corporate Sector Advisory. Good afternoon to you both.
Afternoon.
Hello.
I'd like to start us off, if I may, reflecting on the year that was. In the countdown to the end of the Brexit transition period, the last thing the UK probably needed was a global pandemic and lockdown restrictions that caused the biggest global recession seen in many years. I'd like to start off with a question for you, Ross. As you reflect back on 2020, what was the overall economic impact on the UK? And looking to the bright side, could it have been any worse?
Well, the economic impact, at least in terms of economic output, was enormous and really without precedent. We haven't seen a recession like this in the post-World War II era. It looks like, we don't yet have full 2020 data, but it looks like the UK economy will have contracted by just over 10% in 2020. So that's 3 times the size of a conventional recession in terms of lost output. But in terms of the positives, there were some. The policy response was rapid and sizable. Things like the job furlough scheme, an entirely new structure being put in place, definitely cushioned the labour market, and without that, unemployment would have been dramatically higher. And in fact, even with the furlough scheme, the unemployment numbers have held up. The employment numbers have held up better than feared. So there were some positives. The response, I think, prevented this becoming a much deeper and more protracted economic crisis.
Thanks, Ross. And Rupert, in a service-led economy, did we see any relative winners from what can likely be described as a disruptive 12 months?
Yeah, thanks, Pete. And as you say, it was clearly a disruptive 12 months for almost all corporates. But the impact of the recession, as Ross just described it, it's unusual as much as it was felt quite differently, dependent on sector. And the other factor I think that played a large part here was scale of corporates. So for some sectors and the obvious ones, non-food retail, hospitality, leisure, to some degree auto, etc. They've suffered hugely given the nature of the recession, given the nature of the lockdowns we've seen. Whereas others, whether that's food retail, to some degree pharma, tech, etc., they perform reasonably creditably given the background we've had. And others still, such as building materials, construction, chemicals to some degree, packaging, etc., have performed reasonably well. So it's a recession that's being felt unevenly across the board. From a sector perspective, and as I mentioned earlier, those with scale, those with the ability to adapt quickly, to implement digital strategies quickly, to access capital quickly, have obviously been in a better position to look to thrive, or indeed even start considering how to take advantage of what's been a very difficult time.
Thanks for that, Rupert. If we can now move to the final Brexit deal that was announced a short 4.5 years after the referendum. If I could just start with same question to both of you, but I'll start with Ross. What are your views on the final deal, and were there any surprises for you?
So in terms of the basic content of the deal, the economic and trade aspects, it was largely as expected. So heavily skewed towards trade in goods. So the good news is 0 tariffs, 0 quotas for most traded goods, certainly any goods that meet the rules of origin requirements. So for the manufacturing sector, this should minimize disruption. There will inevitably be some frictions because there will be additional border checks, product checks, new IT systems being implemented and so on. But compared to the risk that we had at the end of 2020 of a no deal outcome, that's a relatively favourable outcome. The problem, from my perspective, looking at this in terms of the whole UK economy, is that the new trade deal between the UK and the EU only covers a relatively small proportion of those economies' economic activity. These are services-heavy economies, as Rupert was mentioning. And the deal does provides some specific provisions for particular services businesses, so for example airlines, telecoms, hauliers, but it's striking for what it doesn't cover, including financial services, but many other professional services. And although some of the wording, if you look at the trade treaty, it often begins with this treaty will provide open market access and ensure non-discriminatory practices, etc., etc. But then in the annexes, there are a whole host of exceptions. So really, we have huge swathes of the economy which are not really covered in any comprehensive way. So that's the first potential snag. The second one is that the deal got held up towards the end of last year because both sides were squabbling over level playing field arrangements, state aid, and so on, and also related dispute resolution mechanisms. And one of the things we'll have to see over the coming months and years is to what extent does this new arrangement result in a huge wave of litigation and tribunal and court procedures as one side or the other lodges complaints about anti-competitive practices, and whether that has the effect of snarling up trade and weighing on investment. It remains to be seen, but it's one of those potential bear traps that is out there.
Thanks for that, Ross. And same question to you, Rupert.
Yeah, just following on from that, thanks, Pete. And I think, given where we were, let's say, in November or shortly before the announcement on Christmas Eve of the agreement, I think, clearly, generally, positive reaction and from corporates and pleased to have got there. Yeah, I think in the context of where we could have got to a month earlier, it's good to have some clarity in a deal. In the context of thinking about where we were originally maybe thinking in 2016, clearly this is towards the hard end of the Brexit outcomes that we were originally considered. I think following on from what Ross said, one of the keys that I see, and I think some of the conversations I've had with some UK corporates are already bearing out, is that whilst there is some clarity, which is great, there's still an awful lot of detail, and the devil will be in the detail here to go, or indeed to be agreed on at later stages, whether that's in the coming months in some cases or years. And furthermore, there's also sort of practical tests on the goods front, which is at the moment. Volumes of traded goods between the EU and the UK is materially lower than it would typically be at this time of year, and that's perhaps masking some difficulties that might appear as importers and exporters get used to new customs arrangements, regulatory considerations, etc. And Ross touched on rules of origin. I think that's emerging at the moment as one potential point that certainly corporates will have to think about in terms of the content in their products when they're distributing that, for instance, from the UK to the EU. On the services side, clearly I don't have much to add to what Ross said. Clearly this is a manufacturing heavy deal. Services is so far very very light indeed. It would be interesting to see to what extent regulated professional services, especially at the smaller end, need to now start thinking more deeply about how they access and serve EU-based customers.
Thank you for that. And if Ross, I can go to you now quickly. In terms of the broad macroeconomic outlook, what can we expect in the short term now the deal's out there?
So in terms of the next few months, really the dominant driver for the economy will be the impact of the renewed COVID restrictions, and that will really dwarf any Brexit-related frictions. On the latter, in terms of perhaps border delays and new IT systems not functioning, the correct paperwork not being there, etc., the Bank of England has suggested that those Brexit frictions could maybe lower GDP by around 1 percentage point in the first quarter of this year. So, it's not a negligible hit, but it's a manageable one. I think with the COVID escalation, you could be looking at an economic impact of 2, 3, maybe 4 times that size in terms of first quarter economic activity. So I think we're in for a tough quarter, tough start to the year. The positive is that the vaccine remains a game changer, and as that is rolled out, we should obviously see an easing of conditions as we move through the year, and you can probably be more confident about that easing taking place. Without the vaccine, it could be a very troubling, dire outlook.
Thanks again. And turning back to you, Rupert, in the sort of towards the end of 2020, you outlined 8 major ways businesses could be impacted by Brexit. Would you like to touch on a couple of the most relevant implications for corporate decision makers?
Yeah, thanks, Pete. I mean, in the near term, I think clearly it's understanding the details. As I said before, there's over 1,200 pages of the agreement. It's understanding the details and how it impacts corporates and their supply chains. And making sure that they can get to grips with the custom rules. Any new regulatory requirements. And follow on pieces like rules of origin, etc. Following on from that, we've seen a pretty significant liquidity build-up, mainly driven by COVID, and we've seen a pretty significant working capital build-up in anticipation of Brexit. That puts a number of corporates, especially at the larger end, in a good place, and gives them some flexibility. At some stage, there'll be a decision about on the working capital front, whether to normalize working capital levels, but we don't expect that. We don't expect that for some time. As I said earlier as well, as traded goods volume starts to increase again, and obviously that will be in part dependent on lockdown easing, and then corporates start to understand better what the new requirements of them are. We may see some difficulties at the border, so preparing to deal with that and to think about how to deal with that is important. In more medium term, I mean, I think one of the positive aspects of the increased certainty, of course, is that potential capex plans, indeed even maybe M&A plans, can be dusted down and reconsidered now. And I think that's something that we will start to see over the coming quarters. And then finally, I'd say people. Obviously, people is a key part of the exit from the EU, and perhaps not it is something that corporates have planned for a long time. But the ability to attract workers, the ability to retain workers, especially for instance, seasonal requirements, is going to be an ongoing issue. So thinking about how to cope with that, thinking about how to invest to cope with that is as important now or more important now than it's been in the last few years. And on that front, as with many others, I think typically what we've seen, and certainly some of the surveys, for instance, in the Bank of England, corroborate this, is that larger corporates have had, by nature, more bandwidth, more time to prepare, more time to consider how they'll be able to adapt and respond. Smaller corporates who will be pleased that there's a deal typically will be perhaps on a slightly steeper learning curve over the coming months.
Thank you for that. And if we can turn quickly now to sort of the longer term outlook, I'll ask a couple of questions if I may. Ross, for you, if you could just quickly talk about how long you think it would take for the UK to return to pre-pandemic levels.
Yeah, certainly. And obviously, what has changed since the tail end of last year is this third national lockdown. So, whereas prior to that, most economists thought from the beginning of this year, from 2021, the first quarter, we would see a sizable rebound in growth. that is going to be delayed probably by one calendar quarter. So we'll get a fall in output probably in Q1, 2 to 4% down, something like that. And then as conditions are eased, the economy will begin its rebound. So that knockback, it becomes more, if you like, that second dip, a sort of W-shaped recession rather than a V, means that it will take a little bit longer to get back to pre-pandemic levels of output. And I think you'd be looking at the tail end of next year, 2022, before UK output was back to where it was at the beginning of 2020.
Thank you for that, Ross. And Rupert, what do you think are the more sustained transition pain points will be for businesses, and how will this vary by sector?
Yeah, I mean, I think as Ross said, in terms, if we talk about pain, I suppose COVID swamps Brexit in terms of the pain that corporates have felt and the need to adapt and move quickly. I mean, I think I said earlier, in the near term, corporates need to adapt quite quickly and understand what the new customer and technical regulatory requirements of them are. They will need to then embed that in their ways of working. And one of the things we've seen from COVID that I think is exacerbated to some degree by Brexit is a reconsideration of the supply chain, whether that's multi-sourcing, whether that's moving more near or onshore, effectively to get more resilience in the supply chain. So right now, whilst at some points Brexit and COVID may lead to a happy coincidence, corporates have really got to think deeply around their supply chain, triggered by both these major events. As I said earlier as well, services companies, obviously there isn't a huge amount here, apart from some of the carve-outs we've talked about for corporates. So a number of them, especially some mid-sized ones, will need to think about how do they set up in the EU, if that's applicable, and how do they comply with national level regulations, which is clearly an additional level of complexity. And longer term, indeed, as I said, in some ways, you could characterise the agreement as obviously a very major step, but the first step on what will be a fairly long journey. Obviously the UK will want to use some of the sovereignty it's found to devise some of its own regulations and rules, and we will see further agreements and indeed further divergence. And corporates will have to pay attention to that, perhaps in a way that they haven't had to the same degree whilst the UK was a member of the EU.
Thank you for that. And if I just move to the one last question, which I'll ask to both of you, and I'll start with you, Ross. In terms of growth opportunities, where do you think they might be, as we think about the future of Britain now the deal is there?
Yeah, I mean, this is the big question. What is the UK's broader economic model going forward? And the honest answer is that I don't think we have seen from the government, from other policymakers, a comprehensive, coherent post-Brexit vision being articulated. We have, snippets of initiatives. It might be, for example, in green finance. There's some discussion about the UK trying to sort of nurture its own homegrown tech sector. You get occasional discussions, people using the sort of phrase Singapore on Thames, could the UK become a low tax, lower regulation economy? So there are sort of ideas swirling around, but I think they're yet to take a more concrete form, let alone any strategy emerging. So inevitably in the near term, I think there will be an element of, if you like, policy firefighting, both dealing with COVID, but also the UK trying to put in place some new trade deals with third countries, notably the US. That might prove tricky. And fundamentally, it's about how do you growth stems from business investment. And it's how do you create an environment where you nurture that investment. The UK, under EU membership, had the advantage that as an international business, you could base yourself in the UK. You could use that as a hub from which to trade in a frictionless way, goods and services across the whole of the EU. Barriers have now been put up post-Brexit to that. And so it remains to be seen, where we find these new opportunities and new markets. And I think the short answer is that this will be a lengthy process. It will take a number of years to put in place new trade deals, new economic arrangements. So I think we are heading for a period of some uncertainty and certainly some disruption. Hopefully, say in 5 to 10 years' time, when a full assessment could be made about that post-Brexit landscape, it will be a positive one. But as I say, at the moment, the details really are very sketchy.
No, thank you for that, Ross. And Rupert, anything to add there?
Yeah, I in total agreement with Ross. I think he characterised it a number of days ago as the vision thing, and the identity of the UK was for businesses was fairly clear when a member of the EU. It's probably slightly less clear now, albeit we are seeing snippets of where clearly the government would like to stimulate further growth, whether that's in sustainable parts of the economy or tech, for instance. I think exactly as Ross said, clearly further trade deals would be positive, whether that's with the US, TPP, whatever it may be. But obviously, a lot of the talk so far has been effectively about replicating the type of deal we effectively have through the EU. And indeed, the UK has less clout now, as we all know. I think the UK does look underinvested in a number of ways, and I think the clarity will allow will hopefully see the UK attract a little more interest now. In terms of growth opportunities, we certainly see growth opportunities in the UK, and we certainly see growth opportunities within the UK corporate base. The UK is still a leader in a number of sectors, and I think if we continue to focus on R&D and we continue to look to develop. So far, it's been sort of rhetoric heavy, but continue to look to develop, for instance, the VC sector a little bit more to support that. I think that would be a positive. In terms of sectors to call out, I think we're pretty familiar with where we expect to see growth and where that may well continue, post Brexit. That's certain aspects of financial services, fintech, green financing. I think obviously pharmaceutical and healthcare more generally should continue to grow. Tech, Ross has touched on, and we've seen a quickening of the pace of the shift to digital over the coronavirus pandemic. And clearly, infra spend as well, and sustainable infra spend as well as part of the government's both levelling up agenda, but also as part of their sustainability commitments, which I'm sure they'll want to see corporates play a major part in. So I think there are key growth opportunities, and clearly we look forward to supporting our clients with them.
Thank you for that, and no further questions for me. So thank you again, Ross and Rupert. I hope you've enjoyed today's episode of On Point. Please do subscribe to our channel to get future episodes and like it, as this will help others to find it. We also encourage you to follow us on social media to get all of our latest content. Speak to you again soon. Goodbye.